Live from New York, I'm Diego Sanchez, president of HousingWire, and my guest today is Anthony Stratis, VP of Lending Partnerships at Figure. Anthony, it's so great to have you today.
And thanks for having me. It's great to be here. It's a beautiful day in New York, and we're excited.
And you're ready to rock.
Absolutely.
This is great. So you've been in the industry for a decent amount of time, including some time at a traditional originator.
Mm-hmm.
What attracted you to your current role at Figure, and what excites you about that role?
So there's sort of a two-part answer to that, right? What was the catalyst for it? Like many mortgage companies, I think, the past 4 or 5 years have been pretty challenging post the refi boom. And so unfortunately, the originator I was at didn't make it through. But for a while, I was always very eager to look at aspects of mortgage that I thought that could be improved, right? Be it, figuring out how to process loans faster, cheaper, better, how to improve margins. And so I was following Mike Cagney for a number of years and thinking about how blockchain can apply to the mortgage industry, and started learning about the Figure product. And it was sort of like multiple things aligned where home equity became a really big thing. And that was one of Figure's strengths at the time. And as I started thinking about what I wanted to do next in my career, it was sort of the intersection of a fast-growing tech business that needed somebody like me, or in any case provided me fertile ground to sort of grow up a partnership business and start distributing the product in an elegant way. And things worked out, and so I started at Figure, and I started at the ground floor as far as the partnership business goes, and it's been an interesting ride.
Yeah, and is home equity, does that continue to be the focus for Figure and your partnerships with lenders?
It's certainly what we do best, I think, right now, right? So home equity is a very sexy product in today's market. I think, everybody understands the fundamentals of the industry. You have consumers that are in their homes, they have a ton of equity. Many of them have mortgages in the 2, 3, and 4s that they don't want to touch. And so it's really a good tailwind for the product itself. But I think the most important part about what we're trying to do is figure out how to distribute that faster. It's still the priority, but what makes Figure special is really the fact that we found a way to originate these in a very friendly way for our partners. And obviously, we're going to try to replicate that across other products. Matter of fact, we probably spent an equal amount of time thinking about what we can do to take the foundations upon which we built HELOC and apply it to other things that we think could be beneficial.
That's interesting. And it has been a volatile year so far. What's your current read on the housing market, and how does that impact your partnerships with lenders?
Yeah, so certainly volatility is a very real thing, especially recently. I think we've seen a lot of tantrums from the markets, up, down, left, right. From our perspective, we feel that the market is within a range. There's kind of an upper bound to interest rates, a lower bound, and we're operating within that range. And while I think some stability would be helpful for us and the industry at large, equally there is a tailwind component to Figure, because we feel we've brought a lot of liquidity through our capital markets execution. And in many ways, our partners feel comfortable working with us because of that depth that we provide.
So you're thinking rates may be higher for longer, which could actually be good for your home equity business.
Within a range, I agree, right? I think, HELOCs are very attractive in today's market because many consumers are locked into their low rate mortgages. And to the extent that they don't want to touch those, obviously HELOCs are very attractive. Equally, there is a ton of equity in the homes that they have, which permits them to tap that equity in order to achieve whatever goals they have, be it debt consolidation, building another bedroom, building a home office. And so as long as we stay within a certain range where they can tap the home equity in an affordable way, I think it's very helpful to Figure.
Home equity can be a competitive space. What differentiates Figure from other home equity providers in terms of technology and other characteristics? Yeah,
I think certainly if you've been following the second lien industry, there's definitely been a lot of competitors that have entered, not just HELOCs, HEI and beyond, right? There's a lot of different companies coming with new ideas on how they can help consumers tap into their equity. I think what really differentiates Figure and what helps us win is the fact that we've come up with an end-to-end solution, and it's not just originations. yes, we have a great originations technology platform. We hear a lot of positive feedback from our partners in that it is end-to-end. It handles disclosures. It makes an LO's life very easy. We have like a little funny metric that we use, but the return on effort for an originator to do a HELOC with Figure is astronomical because they could literally spend 15 seconds and actually have a loan get manufactured. What differentiates us, though, is the fact that we've bolted that on with a really deep capital markets execution platform where we allow our partners to sell loans directly to our investors through our marketplace, our Connect marketplace. And for the more mature ones, we even allow them to aggregate and potentially contribute to securitization. So the fact that we've taken originations activity, do it in a very, very consumer-friendly way where consumers have positive feedback for originating a mortgage. And I mean, who likes to do all that paperwork? We've gotten rid of that. But then bolted on to liquidity and capital markets execution and a lot of optionality for our partners, even with servicing. I think we're unparalleled in the industry as far as that goes.
And so a big focus at lenders and with their top originators is ease of plugging into their existing platforms. How do you do that with your lending partners in terms of their CRM, their POS, and their LOS kind of feeding into your platform?
So like our capital markets platform, I view our originations technology similarly flexible. So legally, you don't actually need to integrate our platform. It is an LOS. It does everything that's required by regulators. It sends disclosures, it does reporting. Everything is sort of in a box and you can leverage that. However, many of our more mature partners, to your point, have their own CRM or maybe have their own LOS that handles LO comp or other functions, right? And so we definitely make it easy to access our data and integrate it with your with any given partner's tech stack, but it's not mandatory. And I think that allows our partners to be really creative about what they want to integrate and what they want to rely on Figure to do, including fulfillment. And that is another unique aspect about what we do.
So you've been busy
Yes.
at Figure with lending partnerships. You have over 145 of these partnerships in place. How have you been able to scale up that partnership business so quickly?
So again, it ties back to the fact that we have a comprehensive end-to-end solution. It is, there's a lot of SaaS providers out there in the industry, right? And I think inevitably what ends up happening is that there's an integration component, there's a fee to actually use that technology, and then a projected ROI. With Figure and home equity in general, actually, what we're selling is revenue. At the end of the day, anybody who partners with us gets an end-to-end solution that they can choose to integrate as closely with their tech stack or as, not at all if they want. And it provides revenue opportunity for LOs. It gives them another product to sell in a way that's really friendly to consumers. And so it's pretty easy to partner with us if you want. Matter of fact, we found, we did an interesting case study the other day where we looked at all our partner base and compared their growth rate to the industry on average. And it tends to be that partners that use our HELOC tend to grow faster than the average. I'm not saying they're growing faster than the average because they use it, but it does demonstrate that those originators are forward-looking and think about what more can we offer, how do we enable RLOs to have more options for their customers, tend to be the net winners.
Well, maybe what it says is that part of being a winning lender right now is a partnership with a great tech stack like Figure.
Yeah, like Figure and like many other products. I think there's a lot of, purchase is subdued, refi is definitely subdued. I think in this industry, in this market, you have to be creative about offering as many options and solutions to your loan officers to meet your client needs now. And if you can actually use that to create deeper relationships that will pay off in the future, so much the better.
Yeah, let's dig on that a little bit. Like you said, purchase activity pretty significantly down. Refi activity pretty significantly down. Margin compression has been an issue for a lot of lenders over the past year and a half or two. How does Figure help your lending partners with these issues around revenue and margin? Yeah,
definitely. So one of the best things about Figure, and going back to our original question about why I joined Figure, it's the fact that it is an end-to-end solution. Even if a given partner of ours only does 5 or 10 loans, you can't actually lose money with Figure because we take care of all of the fulfillment and the economics are sort of net of any of that activity. So every loan that is done with Figure, by definition, is accretive to our partner's bottom line. Of course, we have partners that dig in a lot more, and then they get interested in the capital markets capability, which helps actually expand margins and get additional gain on sale. But even in just a traditional, we'll broker a few loans to Figure model, it's always accretive to the bottom line. And I think the other really special part about Figure is that, great, you can actually get paid on a loan today, but what you're actually doing is establishing another transaction with an existing customer that means that they're 8 times more likely to come back to you in 3 years, 4 years, 5 years, whenever rates do drop, and when they do want to do a cash out refi.
So addressing that full customer life cycle a little bit better. All right, so what does the future look like for the tech stack and your lender partnerships at Figure?
Definitely. So, look, HELOCs are great, and we've discussed a lot how today's market is really supportive of home equity and accessing it, but it's not going to be around forever at the levels it is today. So we are definitely looking at the capabilities that we built to enable us to do HELOCs the way that we do, and thinking about how we can take that foundation and apply it to additional products. Things that come to mind are items like DSCR, fragmented type origination activities, where we actually feel that we can standardize how they're originated, come up with a better way for a consumer to access it, and then because of the standardization, line up a number of investors where those loans can be sold through our capital market solution. And I think you'll see us continue to move down that path where we figure out ways to originate assets better, but also bolt them onto cap markets. DSCR is a good example of something that we're home growing, but I think there's opportunity for other asset classes, and we see this all the time. We actually have companies that are approaching us with other assets, and they're like, I wonder if we can use our technology to originate these in a seamless fashion and then take advantage of the capital markets expertise that you've built. So I wouldn't be surprised if one of those opportunities materialized at one phase or another.
Yeah, it sounds like you have your eyes on non-QM, which is
and for our originating partners, obviously, now that we've got, you mentioned 145, we're actually north of 150 at this point, but we have access and we're already embedded within all of these lenders. For any one of those lenders, as we roll out new products, it's not a very heavy lift to access those products if they like how we're doing things, if in fact the customer experience is better. I mean, we have to prove ourselves every day with our partners, but to the extent that we continue staying cutting edge with what we're doing, we've got that embedded growth because we already have tens of thousands of LOs that have access to our
amazing
ecosystem.
What a great conversation. Really interesting areas that you're looking to expand to. Anthony, thanks so much for joining me.
Thank you. I really appreciate the time and look forward to continue being at the cutting edge of our industry.